Hello everyone, in this video I'm going to be talking about the economic impact of taxes. And here we have a mathematical example of the economic impact of taxes. So we start out with the demand and supply curves before the tax has been levied on the good. To find out the equilibrium price and quantity of the good before the tax has been levied, we equate the demand curve with the supply curve, and we get the price of $10. Now to find the equilibrium quantity, we use the $10 and plug it into any of the above equations, and we get 300,000 gallons. So this is the equilibrium price and quantity before the tax has been levied on the good. Now we want to add the tax amount. Before we can do that, we have to solve for P, and this will allow us to add the tax amount directly to the equation. To solve for P, we have to isolate P on one side, and here we do that by making P equal to QS over 30,000. And now we can add the tax amount, which is $1. It is a unit tax of $1. On the other side, the demand side, we also isolate for P. And this will allow us to equate both demand and supply. The supply equation will contain the new tax, the unit tax, and the demand side will be 25 minus Q over 20,000. To make it easier to equate both of these equations, we turn the fractions into decimals, and this will allow us to add and subtract and move one term to the other side. Here we end up with 289,156 gallons. This is the new equilibrium quantity after the unit tax of $1 has been levied on the good. To find the new equilibrium price, we substitute the new equilibrium quantity into any of the new equations for demand and supply. And this will give us the new equilibrium price of $10.54. To find out the incidence of the tax for both buyers and sellers, we use the new equilibrium price, which is 10.54, and subtracted by the old equilibrium price, and we get $0.54. Every single buyer will have to pay 0.54 in tax as part of the price, and this amount will go directly to the government. For sellers, we can calculate by looking at the tax amount, which is $1, and then subtracting it by the burden for buyers, which is 0.54, and we get 0.46 or 46 cents. We can also use the old equilibrium price and then subtract it by the point where the new supply curve intersects the old demand curve, and that is 9.54. And we can also get 9.54 by subtracting 10.54 by 1, and we get the net price that the sellers will receive after they have paid the tax. To calculate the tax revenue, we take the tax amount and multiply it by the quantity. And here the tax is $1, and it is multiplied by 289,156. This gives us $289,156. The excess burden is calculated by calculating the area of the triangle that we see in the graph here. It is this green area here. And to calculate that area, we multiply the tax by the change in quantity multiplied by 1/2, which is part of the formula for calculating the area of a triangle. And the change in quantity here is 300,000 minus the new equilibrium quantity, which is 289,156. And we get, in the end, $5,422. This is the excess burden, or the total amount of loss in well-being to the society. And this is part of the tax. So when we levy the tax, there is going to be some loss in efficiency in the market. And that is measured by calculating the excess burden. And here we can see that the deadweight loss is the green area. The buyer's contribution to the tax revenue is this blue area here, which is which is 10.54. And we can calculate that area here by multiplying 0.54 with with the quantity. So the quantity, the new quantity, which is 289,156. 156. This is the new equilibrium quantity. And here, the previous equilibrium price was 10, and the net price that the sellers receive is 9.54. So we can see that the incidence here of the tax is 0.54 for the buyers and 0.46 for the sellers. Again, the new equilibrium quantity is 289,156, and to calculate the total tax revenue from the graph, we can see that it is 1. So this entire area, which is going to be $1, multiplied by the new equilibrium quantity, which is 289,156, and we can get the total tax revenue that will go to the government, and it is the sum of these two, the buyer's contribution and the seller's contribution to the tax revenue. And that's how we calculate the equilibrium price and quantity after the tax has been levied, the tax revenue, the excess burden, and also the incidence of the tax. Thank you very much.